we are now prepared to see the full picture of how one solves for their federal income taxes. I'm going to try my best to do that here in this quick little video, but I want you to understand that it's really too complicated for me to explain in just one clip. You've got to read the book. You've got to check out some of those links that are included within the book, and you need to do the practice problems at the bottom of the chapter. Nonetheless, I'm going to do my best here to try to explain how this works. The first step in solving for federal income taxes is to determine your total income. Now, that might seem relatively simple. You might just say, well, I just figure out how much I earn at my job. And that's a good first step. But your total income includes not just salary, but also any kind of side income you got, side hustles and so forth. And also ordinary dividends, qualified dividends, and any short-term and long-term profits on investments. Now, to be clear here, this all needs to happen. Your ordinary dividends, your qualified dividends, your short-term and long-term profits, those all need to occur in a brokerage account for that to be taxable as income. But this is a pretty confusing step for a lot of students because we've learned in the past that qualified dividends and long-term sales on stocks, that those are taxed as capital gains. And that is indeed the case. Those will be taxed as capital gains, but they still get included in this process of solving for income taxes. And we will see why as we go through the steps. So once you've added up all of your total income, you can move on to step 2. Step 2 is your gross income. And it is found by taking your total income and subtracting out any relevant paycheck deductions that you have. Paycheck deductions that we consider relevant here would be anything that reduces your taxable income. So that would be things like traditional 401k contributions, if I could type properly, 401ks, 403bs, 401as, 457bs, anything like that. But traditional IRAs are not included here, and that's because traditional IRA contributions are not from paycheck deductions. When you put money into an IRA, that's money that's usually sitting in your checking account, right? So that's not a paycheck deduction. Other paycheck deductions here that would be relevant would be health insurance premiums, HSA contributions, any kind of FSA contributions would also be relevant here. But in all three cases, health insurance premiums, HSA contributions, and FSA contributions, those are only relevant if they are contributed to an employer-provided health insurance plan. If you buy private health insurance, that will not come out via paycheck deduction and will thusly not be considered a relevant paycheck deduction. Another item here that would be considered a relevant paycheck deduction would be a pension contribution. And there are more, okay? But all of these things come out very, very quickly. You can basically think of these paycheck deductions as being things that are reduced from your taxable income before you even touch that money, right? Contributing to a traditional 401k, for example, that money goes into the 401k before it ever hits your bank account, before you ever see that money. And that's why it comes out right away. These are things your HR department would already exclude from your taxable income before you even have a chance to touch that money. Now, to be clear here, let's make sure we understand that these are relevant paycheck deductions. Contributing to a Roth 401k is a paycheck deduction, but it doesn't reduce your taxable income, so it would not be included here. Okay, so make sure it's actually something that reduces your taxable income. All right, so once we have your gross income, we can move on to step 3. Step 3 is your adjusted gross income, or AGI, and it is found by taking your gross income and subtracting any above the line deductions that you are eligible to receive. Above the line deductions are specific deductions that the federal government provides to really all individuals in the United States that always reduce your taxable income, assuming you actually have income taxes to pay. There's a long list of above the line deductions which are included via link in the chapter in the textbook, but I'm going to mention a couple of these here just so you have an idea of what this looks like. Now, I know a lot of students look at my book, college students, and some of you have student loan debt, and you'll be relieved to find out that student loan interest payments are an example of an above-the-line deduction. And specifically, up to $2,500 in student loan interest payments in a year are deductible. Now, got to take a quick note here and recognize that these are student loan interest payments. If you have $5,000 in student loan payments in this year, not all of that money is going towards interest. Some of that money is going towards repaying the loan or going towards principal. So for example, if you make $5,000 in student loan payments this year, maybe $3,000 of that is going towards principal and $2,000 of that is going towards interest. It's that $2,000 that goes towards interest that is deductible as an above-the-line deduction. Another category of above-the-line deductions, which could be really substantial for some people, would be self-employment expenses. Now, I'm not going to go into great detail here because self-employment expenses are not always deductible. It depends specifically on what those expenses are and how your side income is categorized as far as the federal government is concerned. But in some cases, self-employment expenses could be deductible. For example, maybe you're a full-time worker, but you also own a rental property. In that case, you're earning substantial rental income, which would be included up here in total income. Any expenses that you have on that house could be taken off as an above-the-line deduction. For example, if the toilet breaks and you have to repair it, that would be an above-the-line deduction. But if you add onto that house, you build a deck on that house, that's an addition, and that is not a self-employment expense. So you have to be very careful here. Again, there is a long list of above-the-line deductions that I've included in the book, so you're going to want to make sure that you consider all of those expenses to determine what you're eligible for. Rules on these things change a lot often, so make sure that you are learning about this and investigating it annually as you pay your income taxes. The next step is to solve for your taxable total income. And this is found by taking your AGI and subtracting either the standard deduction or itemized deductions. Another pretty complicated step here, and this is where you have to make a choice. So what you're going to need to do is determine all of the itemized deductions that you are eligible for. This is an entirely separate list of deductions, right? So we dealt with above the line deductions. There was a long list of those. Here's another list of deductions that you might be eligible for. Some examples of some itemized deductions would be mortgage interest, specifically mortgage interest on your house if that is your primary residence or any other kind of non-income earning interest. On the other hand, if you have a rental property, your mortgage interest would be an above the line deduction. Okay, it's a business expense. But if it's mortgage interest on the house that you live in that's not rented out, then that mortgage interest is potentially deductible as an itemized deduction. I say potentially because most people don't take advantage of itemized deductions because it's not worth it for them, as you will quickly see. A couple other examples of itemized deductions. Charitable contributions are itemizable. And also state and local taxes. So if you live in a state that charges very high income taxes like California, those state income taxes are deductible and you would be much more likely to itemize. So what you would do is you would add up all of these itemized deductions, and let's say you're single and you've got $11,000 in itemized deductions. That's great. But to see if you would actually itemize, you would need to compare that to the standard deduction. And the standard deduction at the time I'm writing this in 2025 is $15,000 if you are single or $30,000 if you are married filing jointly. Now, I want to caution you, make sure that you check the book to determine if this is still the case in whichever year you are watching this video in. All right. So if you are single and have $11,000 in itemized deductions, you would not itemize. Instead, you would take the standard deduction of $15,000 down here. Okay. Now, the reason you would do that is you prefer the largest deduction you can get. $15,000 is more than $11,000, so that's what you would do. And that's the case for most Americans. The vast majority of Americans take the standard deduction because simply their itemized deductions are smaller than the standard deduction. And I fall into that camp, okay? As a married person, I have $30,000 in standard deductions I can take, and that dwarfs my itemized deductions. So after solving for my itemized deductions in the past, I'd add up all of these figures here. I've realized that I'm not going to itemize, so I don't have to take that step. I just include my standard deduction. And this makes things easier, okay? The fact that most people take the standard deduction means you don't have to worry about mortgage interest or charitable contributions. You don't need to worry about adding all those things up. If you have a simple tax situation, you're simply going to take the standard deduction. But if you have higher income, an expensive house, you give a lot of money to charities, or perhaps you live in a state with high income taxes, it's going to become more likely that you're going to itemize. So this could be a step where you're doing a lot of work when you file your taxes. Next up, in step 5, fix this up here a little bit. In step 5, we're going to do a split. And this is where we divide out our taxable ordinary income from our taxable capital gains. Now, capital gains will not get taxed as income. So it's very confusing that they are included in this process at all. But remember, capital gains were included in our total income, and our total income was used to determine our gross income and then our AGI. Now, let me backtrack here a little bit and point out that your AGI is very important because it determines your eligibility for things like contributing to a Roth IRA. If your AGI is too high, the federal government does not allow you to put any money into a Roth IRA. So even though your capital gains are not taxable as income, they affect your AGI and thus your eligibility for putting money into a Roth IRA. Likewise, your AGI is determined or used to determine your eligibility for various tax credits. Now, we haven't gotten to tax credits yet. That will be assessed in the final step, step 7 of this process. But your tax credit eligibility can ultimately affect how much you pay in income taxes. So even though capital gains don't get taxed as income, they affect your AGI and can thusly indirectly affect your income taxes. It's confusing, but it is necessary for correctly assessing your income tax situation. That all being said, at step 5, we can finally divorce our ordinary income from our capital gains. And at this point, we have everything we need to solve for our capital gains. We have our capital gains, but we also have our taxable ordinary income. And this is what's used to determine your capital gains tax bracket. This is also what's used to determine your income tax bracket. So step 5, where we divide out our taxable ordinary income from our taxable capital gains, this is a step where we're really able to see where we are in the process. So for example, you might figure out you're in the 12% taxable ordinary income bracket. Great. That means probably your contributions should all be Roth. You might also find that you're in the 0% capital gains bracket. Well, that's good too, because then you could maybe do some tax gain harvesting, which would mean you intentionally sell some of the stock that you own long term at a profit when you're in that 0% bracket. Moving on, getting pretty close here to the end of this process. In step 6, we solve for our taxes without credits. This is where you use the tax brackets, like we've done in the past, to assess your income tax situation. So if you've got 40 grand in taxes without credits, you would run those $40,000 through the tax brackets like we've done in the past. Pretty easy at this point, I hope. And then finally, we get to step 7, which is our your final income taxes. This is the final answer. This is how much you actually pay. To solve for this step, what you're going to need to do is take your taxes without credits and subtract any tax credits you're eligible to receive. Now, tax credits, like I said before, are something we haven't discussed at all up to this point. And there are lots of tax credits, okay? So just like there's lots of above-the-line deductions, or lots of itemized deductions, there are lots of tax credits that you could receive. For example, if you buy an electric vehicle, sometimes that makes you eligible for a tax credit. Or if you put solar panels on your house, that sometimes makes you eligible for a tax credit. So there's lots of things that can be included here. But I'm going to make note of one specifically that a lot of people are eligible for, and that is the child tax credit. The child tax credit gives you a $2,000 credit per child for those that are 16 and under. So for example, I have two kids, one age 6, one age 8. That means I'm eligible for $4,000 in tax credits. Now, tax credits are amazing if you are eligible because they don't just reduce your taxable income like deductions, they actually reduce your taxes. For example, imagine you have a $2,000 tax deduction. That $2,000 tax deduction isn't worth $2,000 to you. It simply reduces your taxable income by $2,000. So for example, if you're in the 22% bracket, that $2,000 tax deduction allows you to reduce your taxable income by $2,000 and ultimately reduce your taxes by $440. Now that's good. A $440 reduced tax bill is great. But on the other hand, a $2,000 tax credit, that actually reduces your taxes by $2,000. So it's actually worth $2,000 to you. Okay? So there are, again, lots of tax credits. One in the book that I go into great detail is the Savers Credit. So you're going to want to make sure you consider all of these tax credits as you're going through the process. All right? Now let's circle back here just to make sure that we know what we're doing. All right, going all the way back here to step one. Step one, we solve for total income. Total income is all of the income you've earned added all up. Step two is gross income. It's found by taking your total income and subtracting off any relevant paycheck deductions like traditional 401ks and health insurance premiums. Once you've got your gross income, you can solve for your AGI. AGI is found by taking your gross income and subtracting off any above the line deductions that you are eligible for. If you have a side hustle and you have a lot of business expenses for that side hustle, you might be able to deduct those here. AGI is extremely important because it determines your eligibility for things like Roth IRA contributions and tax credits. For example, the Savers Credit, which is discussed in the book, your eligibility for that is based solely on your AGI. This is important because this explains why you need to include your capital gains in your total income. If you have a lot of capital gains, that will boost your AGI and might make you ineligible for various tax credits. Once you're done with your AGI, you can solve for your taxable total income, which is found by taking your AGI and subtracting off either the standard deduction or the itemized deduction, whichever is higher. You then, in step 5, split out your income from your capital gains. So your taxable ordinary income is assessed here. Your taxable capital gains are also assessed here. At this point, you can solve for your capital gains and you're done with them. Moving on to the next step, you will run your taxable ordinary income through the brackets, and that will give you your taxes without credits. And finally, in step 7, you subtract any credits you have, and you have your final income taxes. Whew, it's a complicated process. Make sure you run through those brackets correctly using your taxable ordinary income. Make sure you assess your taxable capital gains correctly, again, using that taxable ordinary income. And just make sure you're very careful as you go through these steps because it is very easy to make one mistake and finish with an incorrect answer. And I'm thinking this specifically for the students that are taking my class, but this is also true for anybody that's assessing their own income tax situation. Now, if you're using tax software, it'll try to talk you through the steps, but it's really important that you can do this process on your own. Because if you're trying to figure out, for example, if you're going to make traditional Roth contributions, that's going to be done during the year, not when you're filing your taxes, but during that calendar year. So what I like to do in January is I estimate steps 1 all the way through step 7 to figure out which tax bracket I'm in. And then in November, I do it again to see if I'm still on that same path. If I find out I'm in the 12% bracket, I'm going to need to make sure that all my contributions are Roth. If I find out that my income taxes have push me just barely over into the 22% bracket, for example, well, then that would make it much smarter to make traditional contributions. There's a lot of complicated information that goes into these steps. And if you really are doing things efficiently, you'll be spending a lot of time navigating this system. So I can't say it enough. Be very careful, be very diligent, and make sure that you're doing this correctly. So please read the book. It's hard for me to go through every bit of information here, but I'm trying to give you something here just as another step. But ultimately, you need to read the book. You need to do the practice problems. And good luck. It's tough.